Hi guys, this is lesson 13, how to value a company. Welcome back guys, this is class 13, we're nearing the end. And today we're going to learn something very important, which is how to value a stock. As usual, our disclaimer. Okay, before we begin, I just want to break some of the myths surrounding valuation. I think over the years, because of the brokerage houses or even the investment banks, they tend to paint the picture of valuation is a very hard thing to do, where we have to leave it to the professional, and retail investors will find it hard to do valuation, but that's not the case, okay? Valuation is a learnable skill, and most of us will be able to learn how to value a stock. It's not that difficult, but we have to understand valuation is not really a science. It's an art and a science. And so there's a lot of assumption going in when we talk about valuation. And as an investor, we have to be comfortable with how to create this assumption and how to be confident in the assumption that we are making. Also, I want you to understand that valuation is not the most important aspect of investing. Sometimes, personally, I do not rely on the valuation that much to make my own investment decision. And valuation is only as good as what the valuer is assuming. So there's always mistake in it. We shouldn't treat it as a rule, but rather it's more of a guideline when we're talking about valuation. And when we are practicing valuation, understand that margin of safety is very important. So in a way, if we value a company to be worth $2 per share, we don't go out and buy the company at $2 per share. Make sure we have a margin of safety, maybe about 30%, and we only buy it at $1.40 per share. That's how you create a margin of safety on your investment to minimize your risk. Right. The topic for today is going to be looking through how we value stocks based on 3 types of value, which we talk about in class 11: asset value, current earnings power value, and growth value. Right. And we have to translate what we talk about in class 11 of the story of the company into numbers, and we can put the real hard numbers and come up with a real intrinsic value of a company. I will share with you some of the tools we actually use in valuing it. So number 1, asset value is to find a stock that is undervalued based on its asset. We talk about that. Benjamin Graham made it famous with his net company. A simple way to, as a gauge, is a discount to book value. Your price to book is useful. This is useful for companies that have a very liquid asset or asset that can be converted into cash. So in our example, we talk about Hong Kong land being a good example. We discuss how we come up with the story of Hong Kong land. I just want to share with you, this is the balance sheet of Hong Kong land in 2016 annual report, and we'll just use this as an example of how we're going to create the intrinsic value calculation from the balance sheet. Okay, this is my valuation of Hong Kong land. When we talk about its balance sheet, a good way for us to create our own version of the valuation of a company is to just create 2 columns in it. One column over here is going to be the actual numbers from the annual report. We just copy everything down from the annual report to our Excel sheet, and we're going to make some adjustment. We're going to make some adjustment because the balance sheet numbers are accounting numbers, and they're not really a conservative estimation on what the company value is going to be. So we're going to make some adjustment to it, and then at the end of it, we calculate from our adjustment the intrinsic value that we feel the company should be trading around. Okay, I'll just go through some of the more valuable asset that Hong Kong Land has. In this example, they have a big asset on investment property, because as we talk about, it is one of the main landowners, building owners in Hong Kong Central, and they a lot of these property are very high in value, and in their books they are valued at about US dollars 27.7 billion. Right, that's a lot of money. Similarly, some of the property they own is through the associate and joint venture, again with about 4.4 billion with it. We'll just go down the whole list and see how we're going to adjust it and come up with intrinsic value of the company. So the first one is their fixed asset. It's a very small amount, so we're just going to assume that nothing is changed on our adjustment. We're not going to adjust it. Okay, the second one we talk about is investment property. This is the main bulk of their asset, so we have to make a very conservative assumption from it. We look through maybe in the Asian financial crisis and the global financial crisis, property prices can fall around maybe 25 to even 60% in total. So to make it on average, we're gonna assume that maybe the property in the worst case scenario will drop about 30% from the book value, which becomes just 19.4 billion, right? Similarly, in the associate and joint ventures, because these are just properties that they own where they co-invest. So again, a 30% haircut from it, we get an additional number. All the others, non-current assets, are very small in magnitude. So we can just assume that there's no haircut, and we assume that everything will be the same because it's not worth our time to go through line by line. On the current asset side of things, property for sales are their development business where they have already built this property but is not yet to be sold. So to be very conservative, we can say that maybe 40% of their property will not end up being sold, will become idle, and so we give a 40% discount from the value. Current debtors are people who still owe them money and have not repaid them. Again, to be conservative, we can say that we take a 20% haircut from that, saying that 20% of their debtor is not unable to pay them back. The rest, because it's just cash balance and a small amount of tax asset, we'll just leave it at it is. And these two figures right here, from the non-current asset and the current asset, we'll have a different figure from what it presents in the balance sheet. This is our adjusted numbers. When we add them both together, we will have the total asset. Our total asset estimation of Hong Kong Land is only 26.3 billion, whereas its book value asset is about 36.9 billion. So you can see a big difference there, and we're trying to make very conservative assumption so that when we come out with our calculation, it means that we have some certain safety in our estimation. We're not being too aggressive with the numbers. From then on, it's going to be very easy, because from then on, it's going to be current liabilities and non-current liabilities. As a rule of thumb, we do not adjust them at all, because we assume that all our liabilities will come to due and we have to pay all of them back. There's no discount from it. And that's another way to be very conservative in our assumption. And from there, so both our current liabilities and non-current liabilities will stay the same. And then all we have to do now is just to take our current total asset, which is adjusted, minus away all the liabilities, both the current and the non-current, and we'll come up with a new figure for the total shareholders' equity. You can see that in the books, in their books is a book as 31.3 billion, but from our adjustment, we only come up with 20.6 billion. They have a small number of non-controlling interests, so we'll minus that off as well. Next, all we have to do is just to take this total shareholder equities minus the non-controlling interest a little bit, and divide them by the total share outstanding. That is the number of shares this company has. We assume that will not change over the course of the years. Hong Kong Land has shown us that it doesn't change its share outstanding so often because it has a very strong balance sheet. So all we have to do is just divide the two numbers, shareholder equity divided by total number of shares. We have a new book value per share. Okay, on the annual reports, their book value per share is $13.3 per share, but our adjusted one is just $8.78. Right? So this is our intrinsic value of Hong Kong Land that we come up with from the calculation. But then in order for us to invest in the company, we better have a margin of safety before we invest. So we can either have a margin of safety of say 30% or 50%. If we are just having a margin of safety of 30%, maybe just divide minus of 30% of the $8.78, we'll come up with a figure of $6.15. That can give us a gauge on as an entry price to start investing in the company. Or if you even want to be even more conservative, we can have a margin of safety of 50%, and we'll only invest in the company when it's trading around $4.39. So that's how you create a intrinsic value calculation based on the balance sheet for a deep value type of companies. Right, that's the valuation of Hong Kong Land. So what's the advantage of disadvantage of this type of strategy of calculation? Firstly, it's easy to use and it's very fast. We just did the calculation in less than 5 minutes. And it's easy to compare with peers. I can have a bunch of property companies and I just look through all their balance sheet and just make an adjustment. And I easy to compare with all of them. It's easy for me to compare with how Hong Kong Land changes over time with its history. But the disadvantage here is the value might not be realized because for a deep value type of asset, the value needs what we call a catalyst to be extracted. And the catalyst doesn't come by all the time. It means that something has to happen in the company for that value to be realized, right? Either there's going to be a change of major shareholders, or the major shareholders have started to sell properties and want to realize the value of all their properties. And that's a different a situation that arises that makes the stock market realize, hey, this company is going to change and there's value to be extracted. If there's not such a catalyst in place and we just go and invest in a lot of these kind of deep value type of companies, there's a high chance that we'll fall prey to what we call a value trap, where based on calculation, this company certainly looks cheap and have a wide margin of safety, but due to the fact that they lack a catalyst for the value to be extracted, the value is never realized. And even after we bought them, the value will just stay the same. So this is a value trap and is very predominantly in the deep value stock space, and it's something we have to be aware of. All right, let's move on to the second type of value, current earning power value. This type of value is coming from a consistent earning power company. It's almost like a money machine, and they have very predictable future, most apparent with matured company with stable growth, like a telco or even the REIT in Singapore, right? Commonly valued by using things like a dividend yield or price to earning, or maybe even discounted cash flow to give us a sense of how much this kind of company is worth. Okay, from class 11 as well, we talk about Carlsberg Malaysia. If you have not heard the class 11, I do urge you to go back and take a listen on that class first before you come into this class. But we're going to use the price to earnings ratio to value this company, Carlsberg Malaysia. And similarly to Hong Kong Land, we're going to make some adjustment first. So from the annual report in 2016, this is their income statement. And from it, we're going to make some adjustment. So here we go. Similarly, to start the ball rolling, we have to put in what it makes in the income statement in 2016 into our Excel sheet, and we're gonna make some adjustment right here. Okay, and we are not adjusting for what's happening in 2016. Rather, we're gonna make a assumption on what they are possibly going to earn in 2017, and from that adjusted forward earning that we expect from 2017, we're going to put in a price to earnings ratio to it, sometimes based on his peers or sometimes based on his own trading history. And that is the way we come up with a value for this company, right? And we can do that because it's earning for Carlsberg Malaysia or this type of current earning power type of company. Their earnings is quite stable. It doesn't change year by year, and it's easy for us to make such an assumption. Okay. Again, let's go down one line by line. In 2016, Carlsberg Malaysia make about $1.68 billion in revenue. And we can assume that in 2017 is going to be more or less the same. We just assume that it's be growing with slightly less than inflation. Let's assume that inflation for 2017 is going to be 5%, and Carlsberg Malaysia at most going to grow half of an inflation rate, which is 2.5, and we come up with this figure. Cost of sales, we're going to assume that their margin is still relatively roughly the same for both years, and so we come up with the gross profit for the company. From here, other income, we check from their annual reports, going to their notes, the other income in 2016, we feel that it's not really recurring incomes, but more of a one-off income for the company. So we're going to disregard everything. They're not going to have any other income in that year. Sales and distribution, again, we're gonna stay the same, that the ratio of sales and distribution expenses to their revenue is gonna stay roughly the same, at 15%. And this is the new figure right here. Administrative expense, also we assume that it will be the same growth as revenue. And other expenses, we check as well. Other expenses are not non-recurring in nature, and we are not going to put that in for 2017. And we can see that results from operation will be slightly different. Okay, it has 294 million in 2016, and we're going to expect roughly also similar to 295.7 million in 2017. Going down the line, investment income, it doesn't have any investment, so that's going to stay zero. Finance income, we assume that finance cost it is going up, and it will grow as inflation, about 5%. So it grows at 5%, finance costs and finance income. So you have the operating profit from that, and we're going to add in the share of loss or profit from its associate. And this is mainly coming from its investment in the Lion Brewery in Sri Lanka. We can see they make a loss of about 5 million in 2016. But that is because the business in Sri Lanka faced a one-off event. There's a flood in Sri Lanka that caused huge damage to the business and the region, and the business fall into losses. Apart from that, previously, this business has actually been growing very, very rapidly. It's been growing like 50% a year. And we're going to assume that that growth rate will resume in 2017, if not maybe in 2018. So it will resume that growth rate and going to make about 20 million for the company in 2017. Okay, if we add that all up, the profit before tax is going to be different. This is our figure. We're expecting the future profit to be about 310 million, with a tax expense of roughly staying the same, 25.7%. They have a net income of our own expectation of 230.5 million. Okay, there's going to be a small part of minority profit for Carlsberg Malaysia, and we're going to stay the same for the split. Meaning that the portion of minority interest is going to stay the same. And if we minus that off, this will be the final figure that we assume the profit attributable to the owners for going forward in 2017 is roughly going to be 224.3 billion. Okay, 0.3 million. And that again, similar to Hong Kong land case, we're going to divide it by the share outstanding, which is for Carlsberg Malaysia about 305.7 million. When we divide that, we're going to get our earnings per share. Our earnings per share, our expected earnings per share for this company is going to be 73 cents Malaysian ringgit. And we slap that on their 10-year average price to earnings ratio. We can get that from database like Bursa Marketplace, or if you have Share Investor, or if you have Capital IQ, you can get that figure. And we are thinking that it is roughly about 18 times. And we slap that multiple into the earnings per share of 73 cents. We are getting this company being valued at around 13.2 ringgit per share Malaysia. And again, we're going to add a margin of safety for this kind of company. But because Carlsberg Malaysia is such a stable company with such a long history, almost close to 100 years of history, or stable growth, so we do not need to be as aggressive in their margin of safety like in Hong Kong Land's case. Maybe just a 10-20% margin of safety is sufficient. And if you assume a 10% margin of safety for the company, maybe an entry point for this company might be around 11.88 ringgit Malaysia per share, and that might be a good point for us to start investing based on this assumption that I have made. All right, so you can make your own assumption. I encourage you to try it. Do open up your Excel sheet and try to make your own assumption on how the profit might stays, and then put in your expected PE ratios and come up with your own intrinsic value of Carlsberg Malaysia. And but there's also disadvantage and disadvantage for such a method, right? Again, it's quite easy to use. We're making a few adjustments similarly to Hong Kong Land. It's easy to compute. It doesn't take more than 10 minutes. But there's going to be more assumption because we are only assuming the income for that year. And it's going to be very different, especially for a company that is cyclical in nature with a sudden high capex, or company that's facing a turnaround where their profit this year and next year can vary widely. So, and if we are just using this type of method, we might miss out on company that has new growth potential. If Carlsberg Malaysia today decide to start a new business which has tremendous growth opportunity, if we're just using the current earnings power type of valuation, we might miss out that opportunity because we are unable to predict it into the next year's earning. And it's also quite hard to use for conglomerate because conglomerate has many multiple business units, and each unit has their own dynamics, and the income that they're going to earn is going to be different. And sometimes the conglomerate doesn't own 100% of the company, and just to lump it all together to come up with an income statement for a conglomerate is going to be extremely complicated, and it's not something very easy to do. And the last one we're going to talk about is growth value. This is a value that's coming from the future growth potential of a company. These are companies that might not have a very certain current position, but has a good potential future. And we're talking about company like the Facebook and the Tencents of the future. And the value of this company is going to come from the collection of free cash flow generated from this company in the future. So this can be, in a way, we can view this company as a startup or a high growth industry, or being a new disruptor to a current industry. And one way to value such company is to make assumptions and come up with a future discounted cash flow model for the company, which is what we're going to do now. Again, this is going back to the example in class 11. We're going to use the example of Hartelager. We went through their business in class 11, and now we're going to do the discounted cash flow formula for this company. Just to run you through before we start on our example, we just run you through what is discounted cash flow. Discounted cash flow is merely our expected cash flow of this company going through the future. And if this company, we only assume that it will have one stable cash flow every year in the foreseeable future, we can use the stable growth method, which is their future cash flow divided by their rate of return minus their growth rate, and we'll come up with a value for this company. If it's a two-stage growth, from the graph here, it will have a high growth period where it will grow very fast, like maybe 10-20%, and it will stop and go back down to the stable growth environment in the future, which is maybe the same as just what the economy is growing. And if you have a three-stage growth, which is, again, if you look at the graph here, it's at high growth, but it doesn't suddenly jump back down to a low growth environment. It will slowly stagger back its way into the low growth environment, which is maybe more or less more representative of some companies. So if you want to do it in such a way in the three-stage, then we're going to use this formula, which is slightly a little bit more complicated. But we can also use our Excel sheet, which is what I'm going to show you here, how to just use the Excel sheet and come up with a discounted cash flow projection on Hartelager. This is some of the things that we have to create from the discounted cash flow right here. And you can research and see just how fast the company can grow, and then make on your own assumption on how you feel this company is going to grow in the future. I make a small research back on the last 8 years, how fast nitrile glove is growing as an industry, how fast their average price might be growing or even declining, and how fast the revenue is growing. So we can see from 2008 to 2016, nitrile glove growth has shot up 33.5% in volume every year, right? But their revenue is growing only about 24.6%. That's because as the volume increase, the average selling price of the product decreases as well, and the revenue from the whole industry grow, but doesn't grow as fast as the volume, so which is expected. So if we take this figure, we can see that maybe the maximum that this company can grow is maybe just 24.6% annually. So for us to be more conservative, we're gonna be just assuming that the company is growing just 10% for 10 years, and then drop down to a terminal growth of 3% for forever, right? This is a simplified way of doing it. I just want to show you the example of how you could do it. So don't take my intrinsic value as gospel. It's just I'm just trying to create this example to show you how to go about doing such an exercise, and you can come up with your own Excel sheet and try it out yourself. Okay, the starting cash flow from operation before working capital. This is their current cash flow from operations, and we're just gonna assume that's the starting base. And if we add in the change in working capital and interest, which is if we look back the past 10 years, I did the calculation, just look at the past 10 years, how much is the change in their working capital as they grow, is roughly about 10% of their cash flow from operation. So we'll take that as a 10% off from their cash flow from operations, and 10% will be plowed back to working capital and just paying interest on the company. And then we'll have the capex, which again, which we can get sort of getting it from their expected plan from their management discussion. The company is planning to grow its capex very rapidly. It's going to grow a lot of lines into the business, and we estimated that it can at least plow back in about 1.2 billion in capital expenditure over the next few years. And these are just plug figures that we assume. And after that, we're gonna say that once they grow to their expected capacity, their capex following that is just gonna be the depreciation of the company, right? So once we reach that, we're gonna assume that the depreciation a year from their property, plant, and equipment at 5% of their property, plant, and equipment, which we get it from this figure, and we plow it back after year 4, and it will grow as per just the terminal growth rate. And once we have these two value, we have the cash flow from operation minus of the capex. We'll get what we get is the cash flow, free cash flow. Once we have the free cash flow, we can calculate back the present value of the business. Don't worry, I'll share this Excel with you guys. You can download it and you can see how I go about doing the calculation from the formulas. So how we come back to the present value is just take the free cash flow for that year. If it's 2018, it means 1 year ahead, and we have to discount that back to present value, right? And then the way we discount it back is to just have a discounted rate. Discounted rate is a rate that you want to discount the company back. It can be 8%, 10%. Typically, I range them around 10 to 12%. In a way, I see discount rate as my expected rate of return. If I expect at least a 10% return from this company, I'll have my discount rate put at 10%. If I want a higher return at 15%, my discount rate will be at 15%. And this will just pull me back the present value of the company. And 2018, the free cash flow is 21 million. And if we discount it back by 10%, it will become 19.4 million. And we can do it for every year. And that's how we come the present value for all the years. And lastly, at the last year, we are assuming that going forward, the company will just grow at a stable state at 3% a year. And we can that we can calculate what we call a terminal value. So you remember, if we go back to the formula of discounted cash flow, the expected free cash flow divided by the rate of return, which is the discount rate, minus the growth rate. So in this case, we already have the free cash flow that we expect, and we just divide that with 10% minus 3%, the terminus growth rate. So we're dividing by 7%. So 1 billion divided by 7%, we'll come up with roughly about 14.4 billion in terminal value. And remember, this is a terminal value at the year 11. So we're going to discount that back by 11 years at 10% each. We'll come up with a terminal value of present value 5 billion. And we just add up all the present value that we have here. We'll come up with 7.8 billion in intrinsic value. So from this example, based on this assumption, we're going to assume that Hartelager is worth about 7.87 billion ringgit. So from there, it's going to be easy. We just take this figure, divide by the share outstanding. Again, we did not change the share outstanding. It's a plug value from annual report. But if you want, you can assume that the share outstanding might change, and you can factor that in as well. So you just divide the intrinsic value that we calculated, divide by the share outstanding. Our intrinsic value per share calculation of this company is going to be around 4.79 ringgit per share. Okay, so this is just an example. which on how to calculate the intrinsic value. And again, if we want to invest in the company, do plug in a margin of safety, say 20-30%, and this will be the figures that highlight to us what might be our entry point to invest in the company. So that's how you do a discounted cash flow calculation from your Excel sheet on a company. All right, but do bear in mind this method has advantage and disadvantage as well. It definitely advantages is give us a guide on how to value fast-growing companies. So because fast-growing companies sometimes basing on their book value or basing on their earnings, it's very hard to give us a good, clear image of what the company really potentially can become. So doing this exercise give us a guide on how to value fast-growing company, and it also force you to give logical assumption, because sometimes when we come across fast-growing company, very exciting company, we get carried away, and this exercise forces us to give logical assumption. In Hartlake case, we see that the whole industry is growing at about 24.6%, and do we want to assume the company can grow at 100% a year? Is that logical, given that the industry is only growing at 24%? So it forces us to make logical assumption in the exercise, and we can see a clearer picture of what this company potential really is. But the disadvantage is it's going to be messy. There's a lot of unknown inside. Even just expecting the free cash flow is just on our pure assumption. So all the plug value that we put in is going to be messy. I can assure you it's going to be 100% inaccurate. It's going to be an exercise that gives us not a fixed value, but rather just a murky view of what the future could possibly be, right? And lastly, the disadvantage is very hard to compare a discounted cash flow of one company versus the next, because you have to go through the whole sets of research again and make assumption on the new company and a whole range of discounted cash flow assumption on that company before you can even make a comparison. So it's going to be a long and tedious process. So it's very hard to compare between companies based on discounted cash flow. Hi guys, thanks for watching the video. Remember to click on the link down below to get to all the Rise Up, and you'll be able to download even the slides and the podcast as well. I'll see you in the next class. Thank you.